everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. As you can see from the chart, and I'm sure if you've been following the markets at all, you realize that we are up very close to all-time highs in the market. So here we sit, and you could certainly draw that line anywhere from the highs to the lows of the recent market highs back in September. So we're very close. Now you can see from the Elliott wave pattern, the large 5-wave pattern, that we're in a wave 5, only a 52% extension, so plenty of room to run there. And the question is going to be, when we get to this resistance line, what happens? I think that in general terms, the fact that retail traders have not been involved in this market rally. It's been primarily institutions. A lot of money on the sidelines, a lot of cash on the sidelines that hasn't participated. And the way this works from a psychological standpoint is if the market were to break to new highs, it will be all over the financial media outlet. And then once the retail traders come in, then we get the institutions to begin to sell, and that's when we get the corrective move. So the only question in my mind is, are we going to bump into resistance and pull back a little bit before we break that high? But that's my opinion, and the Elliott wave charts back that up. Looking at the SPY, that's interesting, isn't it? Because it's showing that we have a wave 3. Could we have in the cash market a relabeling of that 5 into a 3 to match the SPY? So the SPY is an ETF. So it is designed to track the S&P 500 cash index. The S&P 500 cash index that's the S&P. That's the actual cash index. That's the one you want to follow. It's a lot easier for people to trade the SPY because it's, again, an ETF, exchange traded fund, that mirrors the SPX, and it's optionable, and you can get volume and all the other things associated with it. So it's a lot easier to trade, a lot less margin requirements, etc. Less expensive because it's a fraction of the cost of the SPX. So it's designed at 1/10 of the SPX. So a lot more trader friendly, if you will. So that's already showing a relabeling of the wave 3, which would certainly lead you to believe that we're going to move higher. Pardon me. If we move over to volume, you can see exactly what I was talking about as far as the fact that we haven't had a tremendous amount of volume in this particular move to the upside. But that'll change if we break those highs, as I suspect we will. Then all of a sudden the volume will become rushing in with those retail traders thinking that they have missed out. But note from the chart how low the volatility has been. Look how small these intraday bars have been on the S&P, and then that's been backed up by the fact that we just basically don't have any volume at all associated with it. So that's where we sit as far as the participation. That kind of shows you what I've been talking about. In fact, you can go back and see that we've only had a handful of days with above average volume going all the way back to the first of the year. So it's just not been a well-loved rally. A lot of people have not believed in it, and you've heard the old adage of climbing a wall of worry, etc. And that's pretty much what's been going on. Nobody's believed in the rally, and the market tends to do the opposite of what people think. And Elliott Wave has been showing exactly what the market's been doing. It's been telegraphing it perfectly. If we take a look at the VIX is down around the level of 12, so we can see that we're right at these lows that we've had for the past year or so. And what happens now? We do have a little bit of a descending triangle here in the VIX, which could lead to a bounce back to the upside. Now that would tie into, if that were to occur sooner rather than later, that would be the scenario where the market bumps up and pulls back before it takes a run at those highs. Or we could break that level of 12 and then head back down to 9, which were the levels that we saw back at the end of 2017 and early 2018. So either one of those scenarios is possible. But the VIX isn't telling us much other than there will be some volatility coming at some point down the road. It just depends on when that volatility hits. I wanted to show you TBT. It's interest rates. And going back, here was an Elliott Wave pattern that we had, a really good one. We had a 38% Wave 4 correction, which is one of my favorite levels, spot on, and then we headed down, and here was our target for the Wave 5. Interest rates have been going down and pretty much fell out of this area of support, which was forecast by Elliott Wave, when the Federal Reserve backed off and came back and said, hey, we're going to go on hold. Nobody really thought that was going to happen, but look, it was right here already forecast that something was going to happen. I don't think anybody knew that the Federal Reserve was going to change their stance and basically say that no more rate hikes this year. The Federal Reserve is never that transparent in what they're doing, or at least they haven't been in the past. So we had the interest rates come down, and look, we hit the target dead in the middle, and now we've been moving back up. And for those of you that may not be as familiar with Elliott Wave, what happens when you complete a pattern is you retrace the previous impulse move. So the last impulse move was the 4 to the 5, so that was this right here. So now we're going to retrace that move back up to the previous 4. Now there's no real rhyme or reason as to how long that'll take. It could take a while, but that's the likely target. And you can see in today's trade, we actually gapped up. We've had 2 gap up days in a row. So we may very well go through a period where we have some backing and filling from these gaps. But we also have a really nice zigzag pattern right here that is following along with the march back up from the Wave 5 low back up towards that 4. And zigzags are one of the Elliott Wave corrective patterns, along with triangles and flats that I watch very closely. So I wanted to show you that because it's just such a perfect example of how Elliott Wave was forecasting things that were not out there in the marketplace, not news driven. It was a surprise that the Fed changed their stance, but had you been trading this, you would have been in front of it and on top of the move. And so I wanted to show you the dollar as well, because here's another of the Elliott Wave corrective patterns, a triangle. It's not the greatest triangle, and the reason that I say that is because the more times the lines are hit by the highs or lows, pretty good on this upward trend line. Not as many touches on the lower, but it's still a pretty decent triangle on its own, which basically means we're going to get a pretty decent move out of the dollar. And I think the dollar has been really kind of consolidating and in this holding pattern because of everything that's going on with Brexit. Are they going to have Brexit? Are they not? What's going to happen over there? I don't think anybody really knows. And so we're waiting to see what's going to happen with this. And I think the dollar is consolidating. And once maybe some news breaks there, the dollar against the euro, and if pound's coming back, etc., we will get a pretty decent breakout. So it's about a 2-point move. 200 basis points out of the dollar is a fair move. And we should see that, based on this pattern, very soon. So that wraps things up for this week's update. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.